Margin is basically the deposit that you need to fund a bet. Now, believe it or not, when we buy a spread bet, we have what's called a notional value, which is a theoretical value of the trade. And this number can get quite big, or can appear quite big. And basically, our margin is normally expressed as a percentage of the notional value. So if we bought the FTSE at 6,540.5 and we bought £10 a point, the notional value of that is going to be £65,405. Now, don't worry, you don't have to put 65 grand up. If you're an investor, you would have to, but we're traders. This is what the whole thing is designed for, and the companies understand that the FTSE is probably not going to halve overnight. So they say to us, okay, we'll allow you to put up a margin of 1% of that notional value. So that means the money required in our account to fund that bet is £654.10. A lot better than putting up 65 grand, because we're using capital as a tool here, guys. We're not investing our money looking for an X% return on our investment. We're using it as a tool. So understand that this is a bit of a double-edged sword. Obviously, if you're buying, you're using leverage like this, and you're wrong, you're going to lose money a lot quicker than you would if you weren't using leverage. But vice versa, if you're right, of course, if the market moves up 1%, you're doubling your margin stake. So if you put £654 down at 1%, market doubles, you're going to double that money. Similarly, if it goes down 1%, you're going to lose all your money. And actually, that brings me nicely to margin calls. You know, often if you do have the market goes against you, you've got margin up there, the market moves against you, and you start to get into almost a point where you haven't got the money to fund it, you'll get a phone call. Well, you used to get a phone call. These days it's automated. It comes up, send you an email, or flag up on your platform. Either reduce your position, close your positions to free up some funds, or add some more funds to cover the margin. So that's how that works. Just from a trading perspective, be very careful about adding more margin. You know, if you're in a trade that's not working, I think you need to get out and reassess it, as opposed to just keep putting money into it because you haven't planned the trade very well. But that's just from a trading perspective. The margin is much lower on currencies and Forex, indices and commodities than it is shares, just because, number one, the notional value is higher. It's quite easy to get £250,000 worth of exposure in these, as opposed to £250,000 exposure on the shares is quite a lot. And also, they're also judging it based on the volatility of the market you're trading. For a share to move 1% or 10% in a day is not unusual for some shares, but for a currency or an indice, obviously the DAX or Dow, to move 10% in a day, that's a pretty drastic thing and unlikely. So they adjust the margin to suit. And margin can be as low as 0.1% for some currencies, going up to sort of 2%, indices and commodities. It's higher on shares, between sort of 5 and 25%. It can be up to 50%, depending on if there's news coming out or if they're expecting earnings or something that's going to move the market. At the end of the day, guys, these companies are looking to cover themselves, but it helps you. It just means then you know that any other traders trading with this broker aren't going to blow the broker up, because people are putting up a sensible amount of margin. They're covering their positions. They've got good risk management in place should the market start to do unusual things.